allow me to introduce you to the fourth and final module for this personal financial management training program by Centonomy. So we've had a couple of modules over the last 2 months. Module 1, we tackled principles or the fundamentals of personal financial management, and module 2, we tackled financial goal planning. Module 3 was debt management, and then now finally today we'll be tackling module 4, which is savings and investments, and that's why we're here. But even before we start, I see a couple of you have already joined. I would like to get your thoughts on what are some of the expectations that you have for this class. What was your aha moment for the other module, if you were able to join? If not, were you able to see the recording? So maybe I can call upon Karen. Karen, if you're able to hear me, just say hi. Where are you joining us from? And probably what are some of your expectations for this class? Karen, if you can hear me. If not, I see Luta Oliver. If you can hear me, please unmute, say hi. Where are you joining us from, and what are some of your expectations? This is because with the trainer here, you will be able to customize the training to the pain points that you present or to the challenges that you present, and you'll get solutions that you will use in the implementation. So Oliver, if you are able to hear me, please just say hi.
I can hear you loud and clear. I'm Luta Oliver from Tororo, Uganda. Thank you.
Okay. Maybe I can ask you, Lisa, what are some of your expectations for this class on savings and investment? What would you like to learn?
I would like to learn what I can invest in, because sometimes you may think of like fixed deposits, then you get discouragements that they are not good. So I would like to know where to invest better so that I can be able to get more of where I'm going to invest in. Thank you.
Okay, thank you so much, Lisa. That is insightful, and my friend is taking note of that. I see Njoki Mungai. If you can hear me, please unmute. Just tell us where you're joining us from and what would you like to learn from this session.
Hi, I can hear you. My name is Njoki. I'm joining from Nairobi, and I just want to learn what is available and what you'd recommend, and like the pros and cons of every method or like investment vehicle that you can talk about, and then maybe help us to decide which ones are ideal and which ones we should focus on depending on our goals and needs.
All right, thank you so much, Njoki. And now finally, Yolanda, if you can hear me, say hi to us, where are you joining us from, and what would you like to learn from this session?
Good morning, everyone. I'm fine. I'm joining you from Awil, South Sudan. Like my colleagues have said, I want to learn how to utilize my money in a better way, where to invest, or maybe how to see opportunities in every situation that appears to me. That is what I'm much interested in. Somebody of talking, I've been a fan of putting money in fixed deposit. What are the cons or pros for that? Is it the best, or discover other alternative, better ways of saving? That's what I would like to learn from this. Over to you. Thank you.
All right, thank you so much, Yolanda. And because our trainer is already here, I'm very sure he has taken note of that, and he'll be able to customize this training session so that we all get solutions to some of the questions or the concerns around investments that we have. Caleb, if you can hear me, I will allow you to start so that you can maximize on the time. Allow me not to do the introduction for you because you are better placed to do that. So let me just give you the ball so that we can get started.
All right. Thank you, Kathleen, and good morning, everyone. Welcome to this training today on savings and investments. I'm your trainer. My name is Caleb Mugendi, and I'll be taking you through this session today. I've noted the suggestions and what you'd like to get from this training, and I do think that we'll be able to come out of the training having understood all this. I'll briefly take you through the presentation. To start off, as my name is Kalim Mugendi. My experience is in investment research, portfolio management, financial consulting, and in business analysis. I've been in investments for close to the past decade. My education is a bachelor's in economic and statistics, and I also have certificates from the Chartered Institute of Securities and Investments. And at Centonomy, our mission is to shift our mindset so that purposeful people can create wealth and live abundantly. So one of the main goals that we have in coming up with this training is to try and shift our mindsets to take advantage of the opportunities as they do present themselves.
Maybe Caleb, allow me to just interrupt a bit. So someone mentioned that they are not able to hear you well. I just want to get confirmation from the rest. Are we all able to hear Caleb? Please just show me with thumbs up if you can hear him so that we can proceed. Okay, perfect. All right, Caleb, you can proceed.
Oh, okay, you can hear me?
Yes,
okay.
We can.
Thank you. So we'll briefly start with the investment types. Normally, we do have two main distinguishing segments of investments. We do have our traditional investments that we also refer to as our public investments. And then we have our alternative investments that are a bit different from the public investments. The traditional investments are defined into two broad categories, being equities and fixed income. I do know we have a lot of experience in fixed income. Fixed income involves some of the things like the fixed deposits, the treasury bills, the treasury bonds, corporate bonds, smart paper, something that gives you a fixed return. And some of the characteristics of the fixed income securities are that they are liquid, basically meaning that you can quickly convert your investments into cash when needed. They're highly sensitive to interest rates. So when interest rates increase in an economy or in a country, then the fixed income securities will also either move with the interest rates. Mostly they'll increase if the interest rates increase in the economy, or come down should the interest rates come down in the economy. And your return is made of both the coupon and the principal. So you get interest being the interest payment, being the coupon on your security. We also have equities. Equities is basically ownership in a public company, where you become a part owner. You can become a shareholder in a publicly listed company that's listed on a stock exchange. The prices are visible on the stock exchange, so you can go today and know the certain price of a share that's traded in a company that you're interested in. They're also quite liquid, given it's an open market and you can trade in and out, or you can sell your assets quite easily. Usually takes between usually T plus 3 days before, once you've done the sale or the purchase, before either money is credited into your account or before you actually become a shareholder. And then we do have alternative investments. The one that we mostly have a lot of experience in is in real estate. So we do have real estate backed investments. You can either go and buy physical real estate, where you buy, let's say you buy a piece of land, or you can buy some rental unit somewhere or some office space. That is now the physical real estate. You can also buy a real estate investment unit, a real estate investment trust, that's a REIT. You can also buy into a real estate company, like a real estate operating company. Now, for real estate, it's more of a long-term investment. It's quite illiquid, given that you can't quickly convert your investments or your assets into cash. But they do provide an inflation hedge. Basically, they do maintain their own value, despite having let's say, despite there having being inflation in a country, the real estate investments usually do maintain their own value. They have a bit of a low correlation with traditional investments. That's why they can also provide a hedge. Should your traditional investments, your equities or your fixed income be moving one direction, there's a probability that real estate will maintain its own value or move in a different direction. One of the downsides is the lack of availability of transaction data. This is mainly for purposes of comparability, purposes of calculating returns. There are some companies that do track indexes or indices that follow real estate, certain segments of the real estate market. And this is one of the challenges that they do face in terms of lack of availability of transaction data. However, they do have relatively higher returns compared to fixed income. And then you have private equity. Private equity is almost the same as equities. However, you're just now buying a stake in a private company, a company that is not yet listed on the stock exchange. So again, the problem here is that it's a bit difficult to price. You don't know the price immediately when you're coming in, and it's more targeted. So it's more of you as an investor going to a particular company to try and negotiate for a sale or to become a part owner of that company. Again, it's quite illiquid given there's no ready market for your shares, given it's a private investment. There's also a bit of lack of availability of transaction data, but the good or the upside is that your returns could be relatively higher compared to public equities should you buy into a good and growing company that has a long or that has a competitive advantage and that's in a growing segment of the economy. So I'll say these are the main segmentations of investments. We do have some other types of investments, some niche investments, things that have come up recently, like cryptocurrency, blockchain, or maybe something else that's something like art. That all these also fall in terms of all these also fall into the alternative investments. And I do welcome any questions. We can as we go along, so that we don't leave anyone behind. And if you have any contribution or any question, I'm more than willing to answer them as we go along. All right. So any question on the broad classifications of investments? Okay. So then now that we've defined the various investment types, we can delve into understanding what drives these investments, how to get involved, which investment is right for me as an investor. What now should I do, having distinguished the various categories of investments? So we want to look first at the main I'll say the main considerations that you do take when you're looking at investments, which is mostly what return am I getting and what risk am I going to have to assume to get that return. So how we look at investors is the investors who might want to assume minimal risk, but by assuming minimal risk, the payoff is usually less return. And then try and shift our mindset into saying whether we are assuming enough risk based on our investment goals, or can we actually proactively increase our risk depending on what our investment goals are. So just a brief overview is when we look at the various categories, we can start with the first one being the conservative investor. The conservative investor who is willing to take on minimal risk, but is also okay with less return. Now, I'll say conservative investor does not have to be a blanket term. It can be the difference between your savings portfolio and your investments portfolio. I'd like to take this time maybe to clarify what I mean by that. when I say your savings portfolio, I'm mostly referring to your emergency fund, your, let's say, medical fund, something that your primary objective or your primary goal is access and security. So security meaning that this investment will not fluctuate in value it won't have a lot of swings in value. It will not fluctuate in value quite a lot, and also that you can access it and turn it into cash quite easily. Basically, there's a readily available market and it's a liquid investment. So for your savings portfolio, you can do that conservatively by setting up an emergency fund of like more or less maybe like 6 months of your daily expenses, or monthly, 6 months of your expenses into an emergency fund where you can take a conservative approach to that investment. By conservative approach, mostly we are looking at investing in something that has a fixed return and that's quite liquid. And therefore, the main or the best, one of the best avenues here is to invest in fixed income securities. Mostly fixed income securities that are backed by a government, for instance, like a treasury bond and a treasury bill, and sometimes some liquid investment like fixed deposits. So here, for your savings portfolio, I do opt for taking a conservative approach to that, based on those goals that we've set out of access and security, or access and stability. However, when we're now looking at our investment portfolio, I would like us to try and look at it from the basis of what are my investment goals. What goals do I want to achieve with my money? For most, I would say for most, let's say for most couples, most adults, one of the biggest goals that they do have is education for their children. For instance, let's say you want to take your children to a good university in future, like let's say an Ivy League university or a university abroad. That's really good. That will require some amount of capital to achieve that goal. Then, having written that goal down and having that goal in mind, we would like now you to tailor your investments towards the achievement of that goal. So it's up now to you to see what assets are available to me for me to be able to scale to scale my investments to get to that goal. Some of the things that you'll find is that you might be taking on too little risk. You might be a bit conservative, whereas for the achievement of your goal, you need to be a bit more aggressive. For instance, let's say you have a 10-15 year investment horizon from the time your kids are small till the time you expect them to go to university. That's quite a long period. So you have that investment horizon that's quite long, and during that time you can take on some additional investments that have a bit of a higher risk and return profile. These are investments that are geared towards a bit more of return and slightly higher in risk. So here you can generate for yourself a portfolio that consists of your fixed income securities, in addition to your let's say equity securities or alternative investments. If you do have real estate, they can come here because your time horizon is a bit longer than let's say for a savings portfolio. And then finally, we do have the investors that we term a bit more aggressive, whereby they're taking on a bit of higher risk with the expectation of a bit higher of the higher return. So you're able to take on a bit higher risk with the expectation of getting higher in return. These are investors who might be primarily focused on, let's say, the equities market or the alternative investments, your private equity or your real estate, and they have some factors working in their favor. Like if the investment goals, again, as you said, if it's a 15-year investment horizon that they have, they're able to take on investments that might be a bit less liquid. They might be able to lock their money in for quite some time. They might be able to buy into companies that have good growth outlooks by sacrificing income today, but expecting capital gains in the future. I do know that in some of the prior lessons, we talked about the time value of money. So the time value of money basically means that owing to the effects of inflation, your 1,000 shillings or $1,000 your currency today, 1,000 units of your currency is worth less in the future owing to the effects of inflation. So for investors who are able to, I would say, they're able to postpone their income. They're able to invest in assets that don't give them current income. That also increases the risk. Like, let's say if they buy into a high growth company, high growth companies usually do not pay much in terms of dividends because the company is still growing. It's still looking for any revenue that it does get. It's looking to expand its operations. It's looking to scale. So usually those that money, that revenue that the company gets is reinvested in the business operations. So you as a shareholder in that company, you wouldn't be getting any dividends. You won't be getting any current income. And therefore you have to forego that current income with the expectation of either selling your shares at a higher price or getting income in the future. So that's why growth companies that pay little or no dividends are more or less aggressive type investments. The risk is a bit higher because you won't be getting much in terms of the current financial year, in terms of a dividend payment or in terms of any current income. So I'll say that's how we like to look at it. Maybe just to reiterate, you can have two kinds of investors. You don't have to bucket yourself into, say, I'm a conservative investor or a moderate investor, a moderate risk or an aggressive investor. You can have different, you can be conservative on your savings portfolio, how you go about your savings, savings for a medical fund, savings for emergency funds. You can be conservative on that. However, now when you're coming to your investing, based on your goals and your investment goals and aspirations, then you should assume assets or securities that offer you the best opportunity to achieve those goals. Maybe you need more in terms of returns so that you can compound your assets or compound your investments quite faster. You might have to opt for a bit higher risk so that you can get a bit higher return. And that means maybe pivoting into your equities market, pivoting into your private equity or your real estate. And then for the aggressive investor is someone maybe who does not have a lot of current, current needs for income, and are able to lock their money in for maybe they have a long-term perspective, and they're able to lock their money in for quite a time. Any question up to that point? Something to clarify, or any comment on how we've bucketed these different investor types or qualities? All right, so I hope we do now understand the difference between the conservative, aggressive, and moderate, and that we can look at our portfolios differently. We can have a savings portfolio, set up a savings portfolio, and then have an investment portfolio. The investment portfolio, which is backed by our investment goals. I think there was an exercise to do what are your immediate and long-term investment goals and aspirations. And then based on those goals and aspirations, then we can look to get into investments or assets that contribute or that can help us to scale to that level. All right, so if there's no question, I think then we can go into fixed income to understand the fixed income market, the fixed income category. And I think from the comments when we started, we did hear some of our participants and members having investments in fixed income securities. I'll just like to open it up again and ask anyone to share like what the experience has been in terms of investing in the fixed income market. Again, I think this is mostly for fixed deposits. A lot of us have invested in fixed deposits at the least. So maybe the interest rates in the various countries, so you saw from Uganda, South Sudan. Maybe we can just open it up to hear any comment on what interest rate they're getting and some of the characteristics and experience that they've had in investing in the fixed income market. Yeah. Anyone wants to add the contribution? I know we heard from Yolanda on the fixed deposits and as well from Oliver on the fixed deposits in their country. Maybe you can start us off.
My hand, I've raised my hand.
Yes.
I didn't say. Sorry, Yolanda. Yes, please continue.
Okay. Like I've said before, some of us have been practicing fixed deposits. Sometimes if you have some money that you're not using, you fix it sometimes for 6 months, sometimes for a year, and then maybe you retrieve it when you have other things. And we've also, when we go to the bank, they tell us that you save for education of your child. So they said, if you give this amount and maybe you'll get this at the end. It depends like how many years you put. But I've put the money there. I really don't know the difference, how much I will get between if I put it on fixed deposit or I continually put small money on that one of education. I don't know which returns is high or less because I just put it. So maybe that is the explanation that we want to hear and see. But one experience I have about fixed deposit is it depends on how much money you have. You can also bargain. Like they can tell you our rate is say 9% per annum or 10. But if your amount is high, you can go and bargain. It depends. They can also give you maybe say up to 12. But if your money has not reached a certain level, they might say no. Up to this amount we give you. I think that is the experience I want to say. Thank you.
Thank you, Yolanda, for that. For sharing that. I think we can pick a lot from what you've shared. Yeah. Anyone else would like to contribute? Yeah, maybe if we go back to Yolanda's example, fixed deposits, I think is what is also quite known and quite accessible, being banks being one of the major financial intermediaries in the economy. So the business basically, they do get deposits from customers and they lend out loans to the real economy. So they pay something on you for your deposits, as their cost of funds. They pay you a small interest and then they can lend it out at a higher interest rate, and that's how they make their spread. For banks, again, as Yolanda said, I think that has also been the experience for most investors or most private investors, whereby if you don't have the economies of scale, they can negotiate with the economies of scale, you can negotiate for a bit of a higher interest rate than as an individual coming in to try and get something from a better interest rate from the bank. I think that economies of scale does play a big role in the interest rates that the bank gives you. And they do also have other products like the savings products for education. I think also insurance have the same education products where you save a bit every month, but then you're told 10 years or something, then you're not quite sure after, let's say you want to, let's say you want your money back in 5 years, but it's a 10-year thing. You don't know how much you'll get. So there's a lot of gray areas in some of the products. I would say mostly the ones that I've interacted with in the insurance sector and insurance market, they do have a lot of gray areas where you're not quite sure if you don't finish the term of these products, how much you'll end up getting. So I think that's one of the cons. Obviously, there is some convenience for them. One of them, given if it's your bank, is you can do that. You can initiate automatic deductions from your account, so you don't actually see the money. So it just every month something is going to my savings before actually getting the money. You already know someone's gone to savings. So I think that also helps, especially in the part of discipline, and that's where they can catch you. I think that has helped a lot in the growth of banking products like savings products. However, I would say again, it also depends on your goals, your investment goals, your savings goals. If you just have a savings goal, then that one is fine. But if you do have an investment goal, like an education plan, I'm sure you can get a bit I'm sure you can get maybe a bit higher return if you were to take on some additional risk than going for the savings products. Again, you're locked in too early for when you're doing the savings products. And as we'll see in the fixed income market, maybe just to highlight, there are a lot of times there are fluctuations in interest or interest rates in an economy. So you can find maybe last year the bank was paying 6 or 7%. This year, if interest rates are higher, it can go to 9 or 10. We don't know next year, maybe in 2 years or so, they might be 11 or 12. So there's that fluctuation that you do have. And with some of these long-term education, like let's say an education plan, you might have signed on to a fixed interest rate for the entire life of that product that may not be floating based on the market dynamics. So in terms of higher interest rates, you might lose out a bit. But anyway, thanks for that contribution. I think we can go into some of the specifics of the fixed income market and highlight what other options there are apart from or in addition to fixed deposits, unless anyone else would like to add or contribute. So I don't close anyone out. Okay. For fixed income instruments, basically what a fixed income instrument is a security, a financial security or financial instrument where the issuer is contractually obliged to pay a predefined amount, in interest payments or principal repayments at specific times. Usually, it's usually semi-annual for your government bonds or corporate bonds. Is usually semi-annual. After every 6 months, the issuer pays a certain, let's say if it's let's say the coupon was 15 or 10%, they pay 5 every 6 months. And there are a number of fixed income securities. Some of the types include the treasury bills and treasury bonds. The government is quite a big participant in the fixed income market through the regular issue of bills and bonds. For Kenya, for instance, the government does come to the market to borrow from the public every week through the issue of treasury bills. And for treasury bonds, treasury bills mostly are just short-term borrowings from by the government through the central bank. So treasury bills are just short-term. So you have your 3 months, 6 months, and 1 year. So that's 91, 182, and 364-day treasury bills. So these are issued or they're auctions weekly, whereas for treasury bonds, they have a different calendar. But for, again, in Kenya, it's around once per month where they come to the market to try and borrow now longer term. So a bond is usually a longer term fixed income instrument that is at least more than a year, maybe at least around 2 years and above, while treasury bills are short term. So for treasury bonds, we have bonds that range from 2 years all the way up until 30 years. You can have a 5-year bond, a 7-year, 10-year bond, 12-year bond, 15, 20. So these are the longer term borrowings by the government from the public. And you can either purchase them in the primary auction when they're issued, or you can wait for them to be traded on a secondary market and purchase them from the secondary market. That is, once they've already been issued, now you can buy it from an investor who wants to sell. For treasury bills, again, maybe I didn't mention, they are called pure discount securities or zero coupon securities. That basically means that you buy the bill at a discount, and then you get your maturity. At maturity, you're paid your principal plus the interest at maturity. So no coupon payment in between for the 1 year. Then we also have corporates also come to the market to borrow. They can also borrow long term or borrow short term. Long-term borrowing by corporates is usually through the use of corporate bonds or project notes, but usually bonds are, as I said, 2 or longer years. If a company wants to borrow for, let's say, 5 years to fund expansion or to fund, maybe they want to build a factory, they can come and borrow from the market for a certain period of time, and then they'll repay once the factory is up and running. So that's a longer term borrowing, while commercial papers are still short term, are still borrowings by company, but is usually for short term periods of less than 1 year. So commercial papers, again, are you can compare them to treasury bills, whereby both of them are discount securities. You paid your interest upon maturity. And corporates, again, if you're looking at the risk, it's much more risky, obviously, to invest in the corporate bonds or the commercial papers as compared to the treasury bills and the treasury bonds, because our government is deemed a bit more safe, is deemed quite more safe than a corporate. So a government defaults, there has to be quite a number of things that are going wrong in the country before a government defaults, especially if it's on local debt. There has to be quite a number of things have to go wrong before that happens. So I'll say these are the main categories of your bonds and bills. And as we said, there's also the fixed deposits where you can deposit either in a bank, for instance, or microfinance. Some also do SACCOs, whereby you get a fixed interest per annum every year to your principal. So again, for fixed deposits, if it's in a well-established bank, what we call, let's say, a Tier 1 bank, then again your deposit is a bit more secure than if it's a much smaller bank or microfinance bank. The risk is a bit higher than your systemically important banks. So these are some of the categories that we have for fixed income instruments, and we'll go through the treasury bills and treasury bonds, some of the auctions that we had in Kenya of late, to just see the different terminologies and the interest rates currently and how to differentiate between them. Any question on this? All right. So as you said, for treasury bills, usually the government or the central bank through the government through the central bank comes to the market every week, looking to get some funds from the public, and they do that through the primary auctions. So I'll just go through what we had for the previous week and how the government how it goes about in borrowing. So if you look at the auction results, it's for 91 day, 182, and 364. And the due dates are in March 2024, June 2024, and in December 2024. So basically, this is when these securities will be maturing. And if you look at the amount offered, every week they offer around 24 billion. That's 4 billion for the 91 day, 10 billion for the 182 day, and 10 billion for the 364 day, for a total of 24 billion. However, now bids received is what how investors bid for these securities in the market. As you can see, for the 91 day, investors really bid for the 91 day. This is one that has the highest demand currently, with investors bidding close to 19.4 billion against 4 billion on offer. That gives a performance rate of 484%. The 182 day only had 2.69 billion, that's around 27%, while the 364 day had 1.96 billion, that's around 19.6. So the total bids were still around the 24 billion, but most of this was concentrated in the 91 day. And then as we go down, we'll see why that is the case. So when we come to amount accepted at 18.2 billion means that the central bank rejected close to 1.1 billion shillings of bids. The reason is mostly because maybe the bids were quite higher or above where the central bank wanted to, or where the majority of the funds were. You might have some outliers that were quite high, and the central bank decided to reject that. When you come to the 182 day, they accepted almost all, and the 364 day, they rejected it like 100 million. So out of the 24 billion that was bid, they accepted around 22.8 billion from that. Then when we come to, from this amount accepted, how much was competitive bids and how much was non-competitive bids? Competitive bids just basically means that you, as an investor, you indicate at what price you want to give your money to the government. So you indicate your interest rates, and these are usually the majority, which is 15.5 billion. One of the reasons being because, again, the major participants in this market are fund managers, banks, microfinance institution, insurance institutions that manage a lot of money and assets, and the minimum amount that is non-competitive is capped at 20 million shillings. And usually a lot of these funds have more than that to invest or to place. So anything above 20 million shilling has to be a competitive bid. So that's why, given that these large institutions are the majority investors in this market, that's why the competitive bids are much higher than the non-competitive bids. So competitive bids were around 19.1 billion and competitive at around 3.68. When it comes to bid to cover ratio, this is just basically your bids received divided by the amount accepted. So you see this is around 1.1, so rejected around 10%. So this is almost 1:1. So that's usually how the auctions look like, and this is the data now post the bidding. And as I mentioned, it does happen close to every week for here in Kenya, in terms of the central bank coming to borrow money from the market. In some countries, maybe it happens once in every 2 weeks. Usually once in every, at least once in every week or once in every 2 weeks. When it comes to the purpose or application of funds, as we said, these are maturing instruments, so we do have some redemptions. Basically, these values of 25.39 billion are redemptions. Basically, they're supposed to pay previous investors in the weekly auction an amount equivalent to 25.39 billion. So if they only accepted 22.8 and they have to pay 25.3, more or less it means that they didn't get any new borrowing in this week's auction, but instead they had to pay. They had a net repayment. They didn't have any new borrowing, and we can see why. In the 91 day, they had 22 billion of rollover, or I mean of a redemption, and they only accepted 18.29. So that means they had a net repayment of 3.7 billion. For the 182 days, they had redemptions of 563 million, but they had new borrowing. No, but they had new borrowing of they only had redemption of 563, but they accepted 2.6. So that is new borrowing of 2.1 billion. And for the 364 day, they accepted 1.8, but they had redemption of almost 2.8. So here again, they had a net repayment of 934. So more or less, if you add these three, you still get a net repayment. So basically, this week's auction was used. It didn't result in any new money coming into the government, but mainly they had to pay previous investors. And if you look at the market weighted rate and the accepted rate on the 91 day was 15.5, equal to the market rate. 15.6 on the 182, again equal to the market rate, but for the 64 it was 15.7, just slightly lower than the market rate of 15.8. So at 15.5%, if the government is borrowing at 15.5%, that's quite expensive. Also, you see the interest rates are quite competitive directly from the government. And the reason why most investors are actually keen on the 91 day is if you look at the annual effective rate, basically this 15.5, assuming you can get 15.5 for 3 months, you can reinvest your money at 15.5 for 4 times in the year. That is, after every 3 months at 15.5, your annual effective rate is 16.4, which is quite higher than the 16.1 annual effective rate for the 182 day and the 15.7, which is the same for the 364 day. So basically what we're saying is the highest rate effectively for investors is coming in at the 91 day portion. So the 3-month portion is giving you the highest rates, and that's why investors are more keen on the 91 day T-bill. And finally here, price per 100 shillings, as we said, you buy it at a discount. So it does mature it usually does mature at par, and then that difference is what you get paid in terms of interest. So here you buy 96.3, 92.8, and 86.4. I'll open it up for any questions on this slide, or any clarifications that if anyone has any clarifications or questions on this slide.
Hello.
Hi, Yolanda. Yes, yeah, I see you.
Yes, I'm just finding it a little bit difficult. I'm not understanding this treasury bill option properly. Are you saying that it is done every week, every month in the bank, or how do they do it? I don't know. And how can, say, me or another person go? Is it open to everyone to come and say, yes, I have this I want to put in, or it has some other restrictions that maybe people of this nature or that should be the one to come in? That's what
All
I'm
right.
not understanding.
Okay, thank you for your question. I see also Njoki has a question. I'll get to yours after Yolanda's. So that's basically the process. You're asking on the process if it's open to everyone to invest in government securities. Yes, it is. If I can talk about Kenya, these weekly. Hello, you can hear me? I'm saying, Yolanda, just can you hear me? Maybe just raise your hand if you can hear me, or write the letter.
We can hear you. Yes, we can
Oh,
hear you. I don't know if
okay.
Yolanda is. Oh, okay. All right. You can proceed, Caleb.
All right. So Yolanda, I was saying for Kenya, these auctions are done weekly, and they're done, or it's the Central Bank of Kenya that facilitates these auctions, and it's done on a weekly basis. Right now, they've even opened, or they have a they've come up with a platform where any investor can come in and invest directly. Previously, you had to go through either a broker or your bank custodial services from your bank to invest in treasury bills. But now, using their platform called, I think it's called DAO, you can actually invest directly as a retail investor. The only restriction is your minimum investment for treasury bills is the minimum investment is 50,000 shillings. 50,000 shillings. I think also the investments come in denominations of 50,000, but the minimum that you can invest is 50,000 shillings. But it's open to anyone. It's open to anyone. If you're a resident, even non-residents, you can invest in the primary market treasury bill auctions. I would say possibly if maybe because of time we might not be able to go through the entire process, but if you just go to the Central Bank of Kenya's website, it's something that they're marketing quite aggressively right now to retail investors, that you can just open up an account even using your mobile phone, link it to your bank account, and during the next auction, you can also participate in the treasury bill auction. Njoki was also asking, yes. Yes, this is the DOE CSD. It's actually, yeah, it's the DAO CSD. Yeah, it's this one. Yeah. So you're asking how do you know the rate at which you loan the government your money? So here's the thing. It depends on if you are a competitive bid or if you're an uncompetitive bid. If you're a competitive bid, then you yourself as the investor, you say, I want to loan the government at 15.5, or let's say even I came in at 16%. So if I came in competitively at 16%, then I'll only know if my bid was accepted or rejected once these results come out. You see, like here, bids were almost 19.4 billion, but accepted was 18.29. So you see here, there are almost 1.1 billion shillings that was rejected. And usually these are competitive bids that are usually rejected. It's competitive bids. So here it means that you as if you had a competitive bid, you have to wait until the auction results. So usually the auction results come out around Thursday, and then you're notified by either the next Friday or Monday. Usually you're actually notified by Friday, so that you can fund the amounts by Monday. So the same week you'll be notified if you've been successful, if your competitive bid or non-successful, or your bid was rejected if it was, let's say, if it was too high. For non-competitive bids, these usually are, let's say you have your 50,000, you don't know what rate it will come in, but you're okay with the rate that is coming in at that auction. So for non-competitive bids, for you to know the rate that was accepted, again, you have to wait for the auction results to come out. Usually the bidding happens on Monday, I think, or Tuesday usually it happens on Monday, but you need to have done it by Tuesday, I think 12 noon, and then results come out by Thursday, Friday. So by Thursday or Friday, you'll know which rate that you've been able to secure from the government. And Njoki, again, as competitive and non-competitive, I'm saying competitive bids. What happens is there's a form that either you fill, or if you're using a third party like a custodian or a broker, they fill for you, saying which rate do I want to bid, or which rate do I want to have my money, what rate am I willing to loan it at to the government. So I can say today I'm feeling maybe 15.6, yeah, and someone else says I'm going to bid at 16. Someone else says I'm going to bid at 15. So if you see here, the average rate was 15.5. Maybe the cutoff, the maximum that they accepted might have been 15.7 or 15.8. So if you bid at 16, maybe your competitive bid was rejected. But non-competitive bid is basically I'm okay with whatever rate the auction results in. Yeah. So I'm okay. If I'm non-competitive, I'm okay lending the government my money at whichever rate that this auction comes out at. So you see, like here, the rate was 15.5. If you're non-competitive, you're given this 15.5 rate. Here, like let's say for the 364, it came in at 15.7. If you're non-competitive, you're given that 15.7. But if you're competitive, you have to wait and see if your bid was rejected or if your bid was accepted. Sometimes you can even be competitive, and let's say you bid at 15.0, but the weight is 15.5. You see now, your 15.0 will be accepted, and you'll be below the average weighted rate. So that's one of the, I'll say, one of the challenges of doing competitive bids is sometimes your rate might be below the market weighted rate, and that's what you'll still get that one that's below the market weighted rate. But if you're competitive and it's taken, then that competitive bid, let's say I wanted to bid at 15.7 and it actually comes in, I'm accepted, even if the average weight is 15.5, I'll still get my 15.7 as long as it was not rejected. Is that okay, Njoki? Did that answer your question? And then how the DAO CSD works, I think yes. Okay, thank you. I think we can get into that in one of the sessions. I'll just note that down. Given its popularity, but again, as it is a bit straightforward, but it's okay. I think we'll include a slide including how to navigate your treasury bill investment. All right. Any other question? So as I said, these are treasury bills. The treasury bills are auctioned every week in Kenya. Then we also have treasury bonds. Treasury bonds can be auctioned either, let's say, every month. Sometimes you can have two per month, and we'll just see how it looks like here in the next slide. So this is results from the primary market auction of two reopened bonds. So we have this FXD 1 2023-002. So this means this is a fixed bond, fixed coupon bond. It's the first of its kind that was issued in 2023, And this 002 means it's a 2-year bond. Again, this FXD1, it's the first of its kind. It's a fixed coupon bond issued in 2023, and here it's a 5-year bond. So you see, for the 2-year bond, it's due in 2025, and for the 5-year bond, it's due in 2028. So the amount on offer, or the amount that the government wanted to collect, was 35 billion shillings. However, the bids that it got were 6.5 in the 2-year and 5.8 in the 5-year, for a total of bids of around 12.3, which is around 35% of the target. But as you can see, the amount accepted was quite less, quite much lower. From 6.5, they only accepted 4.8. That's like 1.7 that was rejected. And then from 5.8, they only accepted 1.5. So here they rejected close to 4.3 billion of bids. Yeah, again, competitive bids that were accepted, only 4.2 billion were accepted, and here only 838 million were accepted. Non-competitive 597, and here is 643. So you see here the bid to cover ratio is basically the bid received over the amount accepted, it's 1.5, 1.4, and the 5.8 over the 1.4 gives you 3.9. So here they rejected a lot in the 5-year bond. Most likely, we can see now the reason why they rejected a lot in the 5-year. The market weighted average was 18.5, but they only accepted at 17.9. So it means that a lot of the bids were way higher than what the central bank wanted to accept in this auction. So that's why they ended up rejecting like more than 4 billion, because most of them were in the 18.5 range. So the average investors wanted to get 18.5 in this particular bond, but now the central bank was reluctant to accept those higher rates, so they only accepted up to 17.9. And then the price per 100, because these are bonds that were reopened, so they're already trading, so that's why the prices are above 100. And given this is a bond, there was no redemption. All of this was new borrowing of 6.3 billion. Yeah. Any questions on the bonds or comments? So I said again, for bonds, it's almost the same process, the same with treasury bills. You can still use the government's DAO platform to bid. The only difference is for bonds, again, the minimum. No, I think still the minimum is still the same for fixed coupon bonds. I think the minimum is still the 50,000 shillings as a minimum. If you go to something like infrastructure bonds, then your minimum is higher at 100,000 for the infrastructure bonds specifically. But for the fixed coupon bonds, the minimum again is still 50,000, again in denominations of 50,000. Any question on bonds? As you can see, the interest rates are quite high. If you look at it historically, for a 5-year at 17.9, for a 2-year at 17.7. So the interest rates have been rising of late in the country, and maybe we in the next slide we might see one of the reasons why. Okay. Any question? All right. So one of the reasons why interest rates have been rising specifically in Kenya can be attributed to the Eurobond. You can see. Oh, okay. Njoki has a question on, does this mean non-competitive is a safer bet? Yes, it does. Yes, it is. If you put a non-competitive bid, then you're more or less guaranteed to get the rate that is there. Yeah, the rate that is there is what you'll get. So if you really do want to invest, then you can do non-competitive. But as we said, for retail, you can easily do non-competitive. For institutions is where if you have anything more than 20 million shillings, you can't do non-competitive. You actually have to do competitive. You have more than 20 million shillings to invest. But for retail, you can do non-competitive any day, and you'll get the rate that is provided. So if you really want to get it, you just go non-competitive. Yeah. All right.
I didn't get a clear explanation between the competitive and non-competitive.
All right. Let me repeat that. I was saying for non-competitive bids is where you as the investor, you can mute. Okay, you as the investor, you don't supply a rate. Basically, what happens is there's a form. You say how much you want to invest. Let's say I want to put 50,000 in, let's say in this bond FXD1 2023-002. I want to put 50,000 in this bond. So I say my amount 50,000. Then when you put, there's also a place for rate. You can put non-competitive. Non-competitive means I'm not going to specify the rate that I want from this auction. Basically, that means that what that means is whatever rate that comes here, this weighted average rate of accepted bids, this 17.7 is what will, if you're non-competitive, this is what the rate you got. So for all these 597.1, they got 17.7. For all these 643.6, they got 17.9. So as a non-competitive bid, it basically means I'm not specifying which interest rate that I require from the government. You have the choice to specify if you want a competitive bid. Let's say you want only at 18.5, like these people who had wanted at 18.5, you can specify that I'm only going to give the government my money if they give me a rate of 18.5%. Now, what that brings about is if the rate is too high, the central bank can reject. You see, like here, they got 5.8 billion, but they rejected almost 4.3 billion. So it basically means if you do competitive, that you can be rejected if the rate is too high. But if you do non-competitive, the rate that applies to that particular auction is what you'll get. So as a retail investor, if you just want to, if interest rates have been rising like they have been rising of late, and you just want to participate and get the interest rate in the treasury bills, it's a safer bet to go non-competitive. Again, however, if you have more than 20 million shillings, you're not allowed to go non-competitive. You have to actually state your interest rate. So that's a caveat. But for retail, anything below 20 million, you can just go non-competitive and you'll get the rate. I hope that's okay, Yolanda. I hope that's understood. I think maybe she has a connection issue. So any other question on competitive, non-competitive? Has it been understood? Okay. All right. I think then we can go into the Eurobond. So for the Eurobonds, basically what I like to highlight is the fact that this Eurobond is more or less borrowing in currencies that is not your local currency. They're usually in US dollars because US dollar is a reserve currency of the world. So most Eurobonds are denominated in US dollar, but it doesn't necessarily have to be US dollars. Like we can have a Eurobond maybe that's denominated in euros or in sterling pounds, but as long as it's not the local currency of the issuing country. And for Kenya, for instance, we have a Eurobond that's maturing next year, around I think it's around June, with a outstanding amount of $2 billion. And this is one of the reasons why there have been a bit of uncertainty on how we're going to repay that $2 billion, given again the conditions have changed since when we borrowed. International markets, interest rates are much higher, so you can't go and refinance. So all that uncertainty brought about a bit of increase in interest rates, as we can see. So maybe just a quick highlight from the on this curve on this diagram. Basically, it's showing you from 2022 January to 2022 December, and then finally October 2023. As you can see, we've been shifting upwards, and especially on the one that's closest to maturity, owing to this uncertainty. So investors are requiring a much higher rate than previously, because there's that uncertainty on whether we'll be able to, as a country, will be able to pay or not. So I'll say that's one of the reasons, that's one of the sentiments that has been driving interest rates higher in the country. Obviously, there's also a number of things that do affect interest rates. There's the macro factors that affect interest rates. When interest rates are rising in the economy, usually it is one of the reasons to combat inflation. And we also know inflation had increased quite significantly in earlier parts of the year. And inflation is a key driver of interest rates and policy and formulation of policy in countries, because inflation rate affects, it affects businesses, consumers, it affects everyone on how they conduct their business. So with high inflation rates, more or less most of the times, the interest rates will also be increased to try and combat that high inflation. And that has the effect also sometimes of increasing the uncertainty around some of the risk factors. So also the government also starts borrowing at much higher interest rates. So that's just what I wanted to highlight from this slide, that as a country, we do Eurobonds, we can do Eurobonds. Maybe something that is good to note is Eurobonds at issuance, they're usually marketed to external investors. So they're usually marketed, as you see, most of the times the cabinet secretaries, they go on a marketing spree to these various countries, trying to gauge investor appetite, investor interest in these bonds. And that's why they're usually marketed to external investors, to foreign investors, foreign institutions, institutional asset managers are usually the first people to be marketed to these Eurobonds. So you won't find at the initial point the Eurobond being marketed to maybe local investors at the initial point. However, as we see, Eurobonds are traded, like the 2024 Eurobond that's maturing 2024 is traded on the Irish Stock Exchange. So what happens is, if you're a local investor, but you do want exposure to a Eurobond, for example, you'll need to buy it from a seller in the Irish Stock Exchange. So that's how you'll be able to get exposure to Eurobonds. Maybe I can also highlight that, as I said, these are mostly marketed to institutional investors, large investors, large asset managers, pension funds, institutions abroad, and therefore even the minimum investment is quite high. Usually, I think it's traded in denominations of $200,000. So if you want to purchase even one slice of the Eurobond, you need at least $200,000. So that's why, again, it's more or less for institutional investors, or let's say high net worth individuals who can purchase such amounts at one go. Any questions on the Eurobond? All right. So I hope that's been understood. And this just shows, the next slide just shows the yield curves. Yield curve is basically the interest rates at various tenors. So we have here, we call it a tenor. So we have your 91 day, your 102 day, and everything else is the year, like 1 year up until the 25th year. So I'd like to point out, for a well-functioning economy, a well-functioning market that doesn't have any bit of stress in the near term, or any bit of, you don't have a significant risk coming up, more or less you'll have a upward sloping yield curve. I want you to look at these previous yield curves. You see the way it starts low and then it's like sloping upwards, starts low and then sloping upward. This is what we call a normal yield curve. A normal yield curve basically is under the premise that is based on the premise that you, for longer periods of time, the time factor is basically more risk. You're taking on more risk by investing for a longer time period, because a lot can go wrong in 25 years than what can go wrong in 1 or 2 years. Especially like for us, in those 25 years, we might have 4 or 5 election cycles, so you don't know what will happen in those in those election cycles. We don't know for sure what will happen now. So holding or giving your money to the government or any investor for 25 years, that longer time period is much more riskier than, let's say, you're giving someone money for 91 days, 182 days. So generally, or normally, for investors should be rewarded with a higher return for keeping the money locked in for a longer period of time. So it goes to that risk return. So the longer the time, the higher the risk. So therefore, it should also result in a higher return. However, if you note, right, currently we do have what we call a kinked yield curve. So we have interest rates are much higher on the short term than they are on the long term. So why is that? Why do we have this phenomenon? As I was mentioning, that's why this came after the Eurobond slide. There is that specific high risk event of debt repayment that's coming next year. So it's causing some short-term, I would say, some short-term stress in the market, a buildup of risks that investors are now demanding more to invest with the government over the short term than over the long term. So you see short-term rates, the 2 years that we saw, the 5 years that we saw at around 17.9%, which is much higher than the long term, which is still around 15, 16, maybe 16%. So this is not the normal yield curve. This is we call it like a kinked yield curve that shows stress in financial conditions or in financial markets, and that stress can be attributed to something like repayment of the Eurobond in the short term. Any question on this? All right. So this goes back to the first. That's why we started with the various types of investors or portfolios of investors: conservative, moderate, and aggressive. As we've now seen, usually for a longer term investments, a longer term horizon, you're taking on a bit more risk. So you will be moving more towards the moderate investor, or moderate investor, towards the aggressive side of things. If you have a longer term investment horizon and you're parking your money for a longer period of time, while short term is usually considered a bit conservative. At this juncture, I think I don't know, Kathleen, if we should take a break at this juncture, or we can continue for another 10 minutes.
Let's take a 10-minute break, and then we can come back and start with equities now. But even in the meantime, if you have any questions about fixed income, please just put it in the chat box. We'll be able to address it in the course of the training. So right now it's 12:52. So 10 minutes later, let's come back and proceed.
Okay.
All right.
Thank you. All right, we'll take a short break. If you have any questions or any burning questions, you can put them in the chat and we'll address them before we move on to the equities section. Thank you.
All right. I think we can proceed. But before we do, just by a show of hands, please let us know that you're still here with us. In the chat box, maybe 3 people, just let us know that you're here so that we can proceed. All right. So I see a couple of you, a few thumbs up. All right. So Caleb, I think we can proceed.
All right. Thank you, Kathleen. Okay. So we'll be starting on equities for the next part of the session. And equities, as we talked about, is just mainly buying an ownership stake in a company. So these companies are usually publicly listed companies. And there are a number of things that we'll go through. We're going to go through how businesses raise capital, how to differentiate between, you know, how do I go about investing in equities market, or how do I go about choosing which stock, and then we'll look at some ratios on what we can, on what we can do to actually get an investment idea. So we'll just start. So as I said, how does a business raise its capital? I think maybe I can open this up for anyone who has an idea. You can put it in the chat, or if you want to, you can unmute your mic. Mainly there are 2 main ways of how a business can raise capital, and I think we've gone through one already. Gone through one. We've already mentioned one. So anyone with an idea of how businesses raise capital? Okay, we do know that you can borrow. As we talk about, you can borrow either corporate bonds, you can do corporate debt, commercial paper, or you can also go and borrow from the bank. So raising debt is one of the ways that you can get capital as a business. And the other one is mainly through the provision of equity. So equity is just capital from the owners of the business. Even if you're a sole entrepreneur, you as a sole entrepreneur, you have to invest your own money into the business, and that is the equity that you put in to your business, you know, so you can buy the things that you need to run your business. If it's machinery, if it's what, you need to put in some money. So even as a sole entrepreneur, you have some equity in your business. So those are the 2 main ways. You can either borrow or fund through equity, borrowing through various ways from the bank, from investors, through corporate bonds or corporate debt, and then also equity from yourself or from other equity investors. So equity, you're basically buying into an ownership stake in a company. And the 2 main types of businesses, you can either have a public business or a private business. For the public business is basically one that's open to the entire investing public. They can just go and purchase a stake in your company. And how do companies become public? They either go through an initial public offer, or they can list, which we call an IPO. So the first time that, let's say, Safaricom came into the market, it was listed in the market through an IPO, the initial public offer to the general investing public. And so that was the most common way, or you can also list by introduction. So listing by introduction includes either maybe a company that that decided to purchase you, and then you became maybe a listed company purchased another company, and that company then became listed. Or let's say a listed company was purchased by a private company, and so also this company was listed. So, and then once a company becomes public, you can look up the share prices of this company. You can calculate its value in real time because it trades in the market. So you can go today and see the price of Safaricom, for instance, of KCB Bank or Equity Bank, or any other company listed in the world. You can go and see the prices of Apple, Facebook, Tesla, all these companies that are listed. You can go today and see because they trade in a public market. You can see their value and you can see their share price. So it's very getting information is relatively easier in a public company as opposed to a private company. For private companies, again, as you say, this is more of a targeted, more targeted investments. Usually they're done by large firms called private equity firms that approach a company and try and negotiate with the owners of the company to put in more capital and become part owners and try and help the company grow and scale. So private equity is a bit harder to determine because you need the company to share with you, disclose with you its financial information, to disclose with you its records, financial records, and then after that you also have to agree on a price for you to execute a transaction. So a private company is way more hard to get the information. There's a bit of lack of data, and you also cannot go immediately and ascertain the value of a business based on the share price. Any questions so far, or comment on the difference between the public and private, or anything about how a business lists? All right. So I would like us to go into some of the myths of investing in equities, or maybe just get from you a show of hands of how many people have purchased stock before, and what was your process, or what led you to do that, and maybe just a bit of your experience in purchasing stocks. Anyone would like to contribute? Has anyone bought into Safaricom or KCB, Equity, Kenya Airways? It's okay even for the ones that are not doing so well. Just anyone if you're willing to share your experience and some of the myths or the things that are holding you back from investing in the equities asset class. Anyone with the experience in equities? No? Yeah, okay. You see, for equities, a lot of people might have the myth that you need a lot of capital to start. I think that's one that we've heard a lot. And another one is fear of losing money. So because you don't know how much you'll get at the end of it all, so you fear losing your capital, and maybe also the fact that you don't have a lot of capital to start. Has anyone encountered those, or maybe you were thinking of investing, but then you think about it twice and say you don't have enough capital, or you fear you're going to lose money? Okay.
I just want to say for like myself, I don't have any idea about the equities. Maybe that is also lack of knowledge that prevented people. I don't know what others could say, but that is what is happening. Till we
Okay.
know more, you cannot even venture.
Okay, lack of knowledge is another one. Okay.
Karen, your
Yeah.
hand is up.
Yes, my hand is up. Thank you. And good morning to everyone. I have a simple and basic question. As I am a Burundian, actually, and living in Burundi, I have a very simple question. Are we as Burundians, but member of the East African community, allowed to invest in equities in Kenya?
Yes, you are.
Oh, we are.
Yeah. Well,
So maybe we
it's,
can, maybe
it's
if.
open to the general investing public. Now, the only thing that we'll need to clarify is if you're going to be clarified as a resident or an East African community resident or as a
Yes.
foreigner. And the only thing that does have potential, where that has a potential disparity with a local investor is in the getting of your dividends and the tax rate. So for foreign investors, if I'm not wrong, I think they're taxed at 10%, but then residents, local investors, and also East Africa community investors are taxed at a lower rate of 5%. So that is the disparity in terms of taxation.
My next question would be, is it possible for you to share with us rules and documentation so we are aware of it in case we might be interested?
Okay. I can give you the part of the training. Will give you the knowledge and the know-how of how to go about it. But the actual trading is done by a broker. So you'll need to contact a broker who will then I can tell you the general process, but now a broker will have to connect you, because once you're in touch with the broker, they'll be able to set up your CDS account, and then once you fund your account, then they'll be able to give you access to the markets, so you can trade after that. But as I said, you need to get access to a broker. The number of brokers available, even if you go to like for our markets in Kenya, they are regulated by the Capital Markets Authority, and they do license a number of brokers. So they do have a list of all the licensed brokers. So you need to get a broker that is active in the market that can do that for you, and possibly one that also has a footprint in the regional countries like Burundi, or one that's in Rwanda. Some can also be in Tanzania and Uganda. That might also be able to trade. I think the stock market in Uganda and Tanzania is also open to East Africa community members. Rwanda, I'm not too sure if it's accessible. So you still need, but you will need a broker to assist you.
Thank you very much.
Do you have to
I
pay
think
for
at
the
this
services
point,
of the broker?
Sorry, I didn't get.
I'm saying, do you have to pay for the services of the broker, or how does it work?
How it works is I have a list of the fees that you'll have to incur. Possibly, I think then we can send the presentation to you at the end, if that's allowed, Kathleen. There is that breakdown of fees. Usually there's a setup fee, because they'll have to register you to register your CDS account. And then after that, once you fund your account with money, they do get commissions based on your trading activity. So if you buy during your during your purchase, you'll get a commission.
I think it's also why Stephen mentioned now that in the invitation email, there's a tool that was sent that has some of the questions that will guide you, even if you're when you're having that conversation with a broker or a fund manager, so that it aligns with the goals that you have when it comes to investing. And it will also give you clarity on, in as much as you're talking about paying for consultations with them, it will also give you the clarity of the returns expected for these investment options that you probably want to take up. So I would encourage all of us to just make use of that. And also at the end of the session, Caleb will share his contacts. I know so many questions will arise during the implementation. He will be more than willing to guide you in the process.
All right. Okay, so maybe that was a good introduction. We can proceed to some of them, debunking some of these myths to equities. We've added another one of lack of knowledge, maybe fear of losing, and that you need a lot of capital. I had highlighted some of them based on some of the feedback that I got. One of them is investing in stocks equates to gambling, which is not true. When you're investing in stocks, one of the things you have to really be cognizant of the fact is that you have to invest for a longer period of time. So you have to have a long-term approach to invest in the stock market, because there are a lot of gyrations, up and down, volatility. This week you might be up, next month you're down, this year up, next year down. So there are a lot of there's a lot of variations in the value of your stock. So it's better to take a longer term approach to investing, so that you can hold you can weather the storms along the way. Another one is stock market is exclusively for experts. This is also not true, though there is some level of research that needs to be done when you're investing, but it's not exclusively for experts to do, who can do that research. You can also research a company that you're interested in. By research, maybe you can look at their financials, their financial statements, their results, and we'll cover one or two ratios and one or two financial comparisons, financial results, how to look at financial results in the coming slides. The third one is you can only make money by investing a lot of money. Again, maybe you can only start by investing a lot of when you have a lot of money. This is also not true. You can do if you get a company that you're interested in, you can actually be buying it slowly. You can buy slowly. This month, you set aside some funds to purchase stocks in the equity market, and you can do that consistently. What that helps is it's called dollar cost averaging. What that helps is you cannot really time the swings in the market. Not every, or not say not every. I'll say most people do not. Not even most people. No one really knows the direction with certainty of where a stock will go. So you actually do not have to know where the prices will go tomorrow, the next week, the next month, so as to make money in the stock market. You can adopt the approach of buying stock every every given intervals, or at prices that are attractive to you. That way you average your costs down when the market is trending down, and you're able to get in at a better price, and you stay invested in the market. The next one is high risk means high returns. This is also not entirely true, because what we mean by high risk can be investing in a company that, as we talked about a bit earlier, being an aggressive investor, you are going to have to sacrifice current income. So high risk means investing in a growth company that doesn't pay as much dividends in the current year, or maybe even in the next 3 to 5 years, maybe because it's using all the revenue to continue growing and expanding and scaling. So that doesn't necessarily mean that investing in such a company will generate high returns in the stock market. Sometimes even just picking undervalued companies that are mature, stable dividends can bring about the high returns. And we also have good product is a good product company, a good product gives a good company, which also gives a good stock. The problem with this is we've had cases of companies that had good products and they were being managed well. So you can't say that it's actually also a good company, but the space is not good. Why? Possibly because they did not innovate, they did not move the trends, and in this fast, globalized world, sometimes when you lose your market leader position, sometimes you can lose your market leader position by not adjusting to consumer trends, by not adjusting to technology and the like. Yes, Yolanda.
I have a question on this stock.
Okay.
I understand that for me, I was equating it to gambling, the
Yes.
first whatever, because I understand that when you put your money in the stock, you have to be on the internet to be seeing if market is going high. I don't know whether you buy or you do what, and if it is going low or you sell. I still don't get it. How I can put my money to be there and maybe it can generate that. Do I have to be in the internet to be checking? Because me, I don't have that time. And what will happen if I put money there? Because we also have like an example, another company came in South Sudan here and they said they opened the stock market, equities, or they call them what? And people put a lot of money. And of course, they said you just see online there, you see your money growing. I don't know how it does. So like it adds, if you put $1,000, after 1 hour, you see something has gone high. I don't know if we are talking about if it is stock market or it's another term, I don't know. So that happened, and some people say they withdrew some money, and some people say after sometimes the company disappeared and people lost a lot of money. So I don't know which one is which. How do you put the money in these equities, and then without you being involved, and then maybe it gives you something? That is the question I have, and maybe some little bit of understanding if what I'm trying to say is about equities. Thank you.
Okay, thank you, Yolanda, for that question. The truth is you don't have to be on the internet all the time looking at the prices of your stock or the prices of the company that you bought. Why is this? Because that is more or less moving from investing to trading. So possibly for the people who do that for a living, they are traders for a living, but again, that's not investing. They want to be in and out quickly. Some funds do that. They do that electronically. Again, with the advancement in technology, they can do that and trade in fractions of a second. And usually they do that in large markets like the New York Stock Exchange, US market, Europe, or possibly in more developed markets like Singapore, Hong Kong. Now, the thing with the thing that you've described sounds to me more like a cryptocurrency scam. What do I mean by this? This is mainly someone who guarantees you money, and then there are a lot of things that come up in the financial market. There's this thing called cryptocurrency where you invest in blockchain, you invest in digital tokens that more or less they say there's a lot of use case and applications for it, but it's not that widespread. And other than that, there's nothing much else that it does. What I'll say is, when you give someone your funds to manage them for you, and we'll go through a slide that highlights some of your options for the equities market. You can actually give a fund manager your funds to manage for you, at least then you know that if the fund manager is regulated by a regulator like in Kenya by Capital Markets Authority, if there's regulation, it's under an umbrella of regulation, then at least you know they won't just run away with your money. One day they're here, and the next day they're gone. I mean, because at least there's that regulation aspect of it, and then a fund manager will be able to advise and invest on your behalf, such that you don't have to keep worrying. Have I made money? Has my investment risen today or not? Again, that goes back to the fact that it could be lack of knowledge that you don't actually need to know where the price goes in the next day, the next hour, the next month, the next week, but you're investing for the long term. Therefore, you are able then to ride these waves of going down, going up, because what happens? So when you see that fear, if let's say you're doing it by yourself, that fear can really throw you off, because the market moves up, it moves down, it moves sideways for sometimes even for extended periods. So now immediately moves down. If you sell, you'll never be able to hold any investment for a long period of time, and therefore most likely you're going to miss out on any potential gains. So I'll say there are options. We'll cover them a bit later in this presentation. However, just one that I can easily point out is having your funds managed. You can invest in an equity fund that is provided by a fund manager, and they'll do the investment for you. So now you wouldn't be concerned on the day-to-day. So maybe they'll be sending you statements at the end of the month, talking to you about how the market has behaved, what they've done with your funds, instead of now you going every day to check online on whether, let's say, the stock dropped today, so what do I do tomorrow? Do I buy? Do I sell? That actually breeds more into your fear of losing, and that's why we're saying you need to shift our mindsets to a longer term investor to be able to accept a bit more risk for that potential return based on our investment goals and aspirations and objectives. I don't think if I've answered you, Yolanda. That's understood.
You did answer, but it will take me time to understand this one.
Okay. Then we can just say it's not, investing is different from gambling, totally, because gambling, again, you see one of the main things in gambling is quick reward. So let's say I'm gambling. I put the ones that we know. I think everyone knows here. Your sport pesa. You gamble on outcome of a match. Immediately the match is over, you know whether you've lost or whether you've gained. So gambling is more of a quick reward kind of system, whereas investing is a long-term endeavor. So you're supposed to get different the payout, the rewards should be different. One is immediate, the other one is more long term. So once you shift your mind to stocks is more long term, gambling is short term, short risk, short reward. Investing is long term reward. Any other question on the stock market myths? Okay. So one of the ways to look at how to go about possibly investing in the stock market is look at the trends in an economy. You can look at the trends in terms of which industries will most likely thrive, or which industries will be at the forefront of shaping how our future will look like in the next decade or the next 2 decades. One of the examples that I can give is before COVID, we our lives changed a lot after COVID. You can see right now we're on a Zoom call. Before COVID, that was not as widespread. And Zoom is actually also a company that's listed on one of the stock exchanges in US, Nasdaq Stock Exchange. So you see, during that time, Zoom became quite popular as people adjusted to working remotely, to online meetings, to keeping you're keeping your distance and staying at home, working remotely from the office. Therefore, we still had to connect somehow. And Zoom, using that digital video conferencing, was one of the companies that really emerged during that time. And investing in Zoom when it IPO'd on the market also gave investors a good return. And these are some of the trends that are shaping our future. Some of the other things might be, moving from moving towards green. There's a lot of emphasis now on climate, global warming, moving to green products, green companies, and the like. So something like EV electric cars have also been. They also started to be some of the things that will shape our future. So just looking at how the future will be shaped, which industries will thrive in the future, can be one of the ways that you can generate ideas for investments in the equities market, because these are companies that are operating, they're scaling, they are expanding their services, they are expanding their reach, and thus benefiting from advancements in technology and trends in various sectors. So that's one of the ways that you can use to identify companies or stocks or equities to purchase, or where to put our money, basically, by looking at companies that are most likely going to shape the future in the next 10 to 20 years, next decade. So one of them that we highlight here is agriculture, with the focus on sub-Saharan Africa being possibly even becoming the food basket of the world. I'm sure agriculture is an area that hasn't been fully exploited to its potential. So that's one of the areas that will still keep shaping the future in Kenya. Healthcare is also one of the areas that have really come up, especially again following the COVID pandemic. We had companies that also debuted with their vaccines. Some of the companies again that are listed that were listed around that time. We had the Moderna vaccine. We also had the Pfizer vaccine. So these are big pharmaceutical companies in healthcare that are at the forefront of generating solutions to the healthcare problems, and investors also coming in to invest in these companies also got a return, a large return on their capital. Again, also with health, even past the pandemic, as we see, there are more as humans' lifespan continues to be increased or to be lengthened. There's also more lifestyle diseases that are coming up that also need to be taken care of. And there's also the healthcare during retirement. So it's still with the retirement people increasing over the world, it's also still a huge growth area. And companies that are at the forefront in providing solutions in these sectors can be one way that you as an investor look for such companies to invest in over the next 10 to 20 years to give you a good return on your capital. And finally, we have the digital products, the digital economy that's also thriving. A lot of things now online. You have online brokers, online services, online. There are so many services that are online, and digital services and products are also have also become the way that, or almost become the way that we do business nowadays. So with the improvement in technology, access to smartphones now is more available, is more widespread. So most people have the access to these digital services and digital products, and thus basically you can interact with people more or less in any part of the world, unless, as long as you have internet connection. So these are some of the things that are shaping our future. So companies that are still operating the digital space, payments, digital payments, providing services online are still expected to do well in the next decade, given how we've changed the way we do business. Any question on that before we move on? These are just some of the sectors. Obviously, there are those that are still going to maintain, maybe even the next 10, 20 years. We might still have need for banking services, insurance services, that are still mainstream and still mainstay. However, that doesn't mean that some of these other sectors won't do well. All right. So I just want to briefly talk about what makes a good business. You have your should-haves and your must-haves. The must-haves is things like you must have a product that meets a certain solution or certain customer need. You also must have your distribution center, how you get your products to the consumers. How do you get your revenue? Those are some of the must-haves that make a business. But some of the should-haves are things like a competitive advantage. Let's say you have the lowest cost product, so that gives you a competitive advantage towards other companies in that sector. Let's say you also have technology on your side that gives you a certain marketplace that wasn't accessible to other people. That's what makes the business good. And also I should have is also like something like you're able to react to any trends that occur in any emerging trends that occur when you're going about your business in your industry, reacting to those trends, reacting to the change in consumer behavior, reacting to change in technology. Those are some of the should-haves in a business, and that's what makes a business good. I want to pivot and now get into some of the technical details of what is the true worth of a share. How we do this is by looking at the fundamental, by doing fundamental analysis to look at the fair value of a stock. When you talk about fair value, another name is the intrinsic value. This is just what we believe is the true reflection of the value of a company. So the fair value just looks at the price that, given all that we know about the prospects of this company, the assets, the financial statements of this company, and the industry that it's in, and its revenue, how it gets revenue, how it spends its cost. I think having done some financial techniques, we can come up with a fair value for a certain share, for a certain company. And that process is mainly called fundamental analysis. So here, there are a lot of techniques. Mostly this is done by equity analysts, by investment analysts and advisors, by financial or business analysts and advisors. So it's a bit above the depth of the training today. So we would, and again, it's not a must you go into the in-depth fundamental analysis yourself. Usually, when we advise clients who possibly do have a connection with a broker, the brokers usually do have research and analysis teams that do research on these companies on a day-to-day basis. So they are able to advise you and generate research reports that can guide you in making better investment decisions. But still, nonetheless, we do want to tackle some key ratios that is good for you to know as you go about investing in the stock market and how you go about looking at companies. So some of them, what we'll be covering are the earnings per share. We call this the EPS, the price to earnings ratio, PE, and the dividend yield. These are some of the tools that we can use to figure out the value of a share. And we'll go through them one by one. So don't worry if you don't yet understand them. So for earnings per share, earnings basically means your net income or your profit. So it's your earnings basically after you have your revenue, you have all the costs that you use to generate this revenue. Then you have your profit before tax, and then you pay tax, and then finally you have your net income or your profit after tax. Those are your earnings, and how you look at it is earnings per share. So you basically take all your net income and you divide it by the number of shares that you have outstanding. So let's say I have a million in earnings and I have a million shares. Basically, that means that I have my earnings per share is one shilling per share. And here, the higher the earnings per share, the better. So how I want you to look at it is the company getting higher and higher earnings per share in subsequent periods? Like let's say today, from the example, we got 1 million shillings and we have 1 million shares. So my earnings per share this year is one shilling per share. Let's say next year my earnings drop to 800,000 and I still have the same 1 million shillings, then my earnings have gone to 0.8 per share. So you see now here, instead of increasing my earnings per share, my earnings per share have actually come down. So that is not a good sign. They've come down by 20%. Instead, I'll prefer having my earnings per share go maybe to 1.2, 1.5 earnings per share. So that's why we're saying the higher the earnings per share, the better. So it's just mainly looking at, for each share that I own, how much earnings am I getting per each share that I own? So normally usually you'd want as high as possible. So the higher as possible earnings that I control with one share, the better I am for me. And then you also then look at the trend over time. Is my earnings per share increasing? That means that the company is becoming more profitable. It's growing faster. I mean, it's growing. It's becoming more profitable. It's becoming more efficient, and that is paying off by each share getting more and more earnings as the years go by. Any question on the earnings per share? The next thing is the price to earnings ratio. Now this one, it does use the earnings per share that we've just talked about. But now we get the earnings per share and we get our market price per share, and we divide our market price per share by the earnings per share. It's basically the price divided by the earnings. That's why it's P to E, price over earnings, price to earning ratio. So here, what this ratio basically shows you is how much am I paying today for 1 unit of earnings. So if I'm paying 10 shillings for 1 unit of earnings, it's a bit more expensive than if I'm paying 5 units per each unit of earnings. That's why you want to buy the cheaper one, or the cheaper one is better. The lower, the better. So if I'm paying so much for every individual earnings that I get, then the price to earnings ratio is much higher. Let's say in this company, just going from the example, if my earnings per share is 1, but in the market, the price per share is 10, it means that I'm paying 10 times for every 1 unit of earnings. So that's a bit high if you compare that to, let's say, someone who's paying 5 times for every unit of earnings. And some other people, some other shares might be 20 times the same earnings. So here you'd want the lower, the better. But there's a caveat being, you also have to distinguish the same amongst the industries. So you might find a particular industry, the price to earnings ratio is around, maybe the average is around 5. But in another industry, let's say it's a highly growth industry that we've been talking about, the high growth industries might have much higher price to earnings ratio. Let's say a technology company might have a 20 times price to earnings ratio. So just by looking at that, will the 20 times price to earnings ratio be better than, let's say, a bank, for instance, that has a 3 or a 5 times price to earnings ratio? We can't say for sure because they're in different industries. However, if both of these were banks, one bank had a 20 price to earnings ratio, while the other bank had a 5 price to earnings ratio. Being in the same industry, then we can clearly say that the bank that has a 20 price to earnings ratio is more expensive. So I will prefer as an investor to buy cheap. You know, you're always trying to buy things that are cheap. That's the basic element, is to buy low and sell, buy low, sell high. So if something is cheap on a financial metric, a financial basis, a financial metric, then it's a bit more attractive than something that's a bit expensive. So if they're in the same industry, you can look for the company that has a lower price to earnings ratio as compared to its counterpart that has a higher price to earnings ratio, to buy the cheaper priced one in the market. Yeah. Any question on the price to earnings ratio? Yes, Karen. So you've raised your hand.
Yes. Do we have access to all those informations by ourselves from a website of the company, or do we need to talk all the time to the broker to get all those information and make the calculations ourselves and compare?
Yes. For this one, you need to do a bit of research. Usually, your broker will provide at least a weekly update. If your broker does go through all the companies, they'll be able to provide a weekly update on the key ratios like the price to earning ratio, the earnings per share, the dividend yield. They do provide that on a weekly basis. However, you if you want to do it by yourself as a retail investor, you can get access to these metrics. If you can get access to these metrics, I'll say some sites do offer these. Some financial tracking sites do offer these ratios. One of them being, I think the one that I can recommend is Reuters. Reuters, Reuters. If you have a company, you can go and try and type that company followed by Reuters and see the various metrics. I'll recommend that as a more or less like a free version for it. Others that pay, you know, the Bloomberg that pay, you'll have to pay to get that information. NSE also can provide that info, and some of these stock trading applications. Again, they're mostly the websites that do track some of these financial information. So the info, it is there, but you have to have a bit of experience in knowing where to look, or possibly just relying on your broker if they do weekly, because most brokers do weekly analysis of the companies, let's say in the stock market, that have the closing price for the day, and then they calculate the ratios based on the price, because the price is what changes mostly. Things like earnings per share, they change when the company releases financial information, so that one can stay the same for a while. But then the broker will be able to send you, possibly if it's at the end of every week as a breakdown or a summary of the key ratios that determine, you know, the key financial ratios for this company. I hope that has answered your question. I see Yolanda also has raised your hand. Yes, Yolanda.
Yes, thank you. I just have an example of myself. Maybe you can give me advice.
All right.
I have a financial institution here where I bought some shares.
All right.
Like I have 5% of the total, whatever they have there. And that was in 2019. And in 2020, at the end of the year, they gave us what they call dividend. That was earned. And in that dividend, I was having almost like $200. That was what I got.
Okay.
So as a dividend. Then in 2021, I added the shares up to 14%. And then the dividend was $870. That is for the year. Because they said the market was not doing well, blah, 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 like that.
Yeah.
And in 2022, I did not, because the other one I was in the process of paying, my whatever became like 15% of the total shares. And then the dividends, they say it's like $1,100. So if I look at the rate at maybe the dividend is coming to me, and then with the inflation and the rest, do you think it is worth increasing the shares in that whatever, or I just leave it like that? Because I don't see too much difference. The other one was 800, now it is 1,100. I don't know, it will continue like that, or it will come down, because they also say it depends on the market, the borrowers, and the less. If they make more money, you get. If they don't, then you don't get much. And the other one is, there was some time that I didn't have money, and I'm like, are we allowed to borrow from wherever we have invested? They say no, it's like conflict of interest. So it's a little bit limiting me now. Like, do I really have to continue investing, or I just leave it the way it is? Thank you.
Thank you, Yolanda, for that detailed explanation. Maybe I can just ask this: who are you using to do this? Is this a fund manager, or is it a company?
There is a microfinance institution where it gives, it's called Dynamic Frontier, Financial Frontier something. It's a company that is giving loans to, of course, to women, whatever, like they borrow, they bring back, like that. It was an institution that was one of NGOs were managing. I think I understand they mismanaged some of the funds, and then they were closing and they sold it, and some people bought it and they started, and these people had interest that they were paying, or whatever the other person who sold to them. I think 2019, 2018 there, they started paying back whatever the other institution was having as a debt before it became completely there. So since I joined, that was what is happening. At least as it's a microfinance institution that is lending, and of course, giving people loans. It's not to big scale holders, but these small business services.
Okay. So then so you've invested as you've become a part owner, or are they just giving you
a shareholder? Yes.
Oh, okay.
Yes.
Okay. All right. So then this is a good example of private investment in equity. So this can be termed a private equity investment transaction, because the institution is not publicly listed, so we don't have that much information on it. As we discussed, some of the characteristics of a private equity transaction is again, the returns could be higher in private markets than in public markets. Again, also, it becomes a bit difficult to price your investment. So when I say becomes a bit difficult, then it means unless we are given the financial information by the company, then we can't know for sure the value, the actual value of the stock. But looking at it, looking at how you've said the dividends has increased, the time it's increasing by even close to 30% increment in dividends, even though you did add your some funds to it. So here again, given it's a private company, the information will be a bit scanty on from the public, like for an outsider like me, unless you yourself do have that info. I think then I'll be a bit better placed to advise. Maybe just a general comment though. How a lot of these companies work. Yes, you do invest, and you get a return on capital. This is after they've gone and done their business. So depending on the prospects of the company, if the prospects are increasing, the company is well run, the prospects are increasing, they continue to do well in terms of the financial results, then there's a possibility that they'll continue paying dividends, maybe at the rate that they've been paying. Again, without information, we can't go too deep into the details, like the financial details and the like. However, I would say, given that, I will say maybe to make that decision, given your investment goals and objectives, if this investment is helping you achieve them, through your capital appreciation and your dividend payment and the like, if it's helping you now achieve your investment goals, then that one can be considered necessary risk that you'll need to assume to get your investment goals and objectives. Then after that, then you also might have to do something like figuring out that investment vis-a-vis maybe another investment. Now you can do the comparison. What we can look at is the next slide on the dividend yield, to figure out whether the dividend yield that you're getting is worth it, and maybe if you can get a dividend yield, comparable dividend yield, maybe in another company or in a listed company, or if it's quite attractive to you at the current rate. So those are some of the things that you need to possibly calculate. Maybe we just go to the dividend. The dividend yield basically is your dividends per share over your share price. So how Yolanda you'll calculate it is the dividends that you receive divided by the total cost of your purchases or of your investment. So your dividends divided by the total cost of your investment will give you that yield. So if you're looking maybe at the last one, maybe at $1,100, then you divide that by the cost of your purchases, and then you'll get your dividend yield. So now this dividend yield is what you can now go and maybe compare with similar investments, maybe in public markets that are more accessible, to see if it's attractive or not. Yeah.
Thank you.
So yeah, I think if you do want to, I'll leave my email at the end of the presentation, so we can engage further on if you will have any further questions or considerations. So as I was saying, for dividend yield, that's how you calculate it. You get your dividends per share over your share price. So if you've already invested, you can take the share price that you bought, that you purchased, basically your cost basis per share. Yeah, because so here you assume a new investor will just take the share price in the market. However, if you've already invested, then you need to use your cost basis. Like, let's say the market price is 10, but I bought it at 12, then my dividend yield will be, you have to use the 12 that I bought it at for me. But for a new investor, then or if I wanted to add money, then you can use the current price. So for, as I said, for a new investor, you use the dividends per share of your cost basis. But for investor who's already invested, but for a new investor, you're trying to compare, you use your dividends per share over the share price to get your dividend yield. And here, the higher the dividend yield, the better, because dividend yield is more like the income that you're receiving in this financial year as the company pays out some of its profits to the shareholders. I don't know if that is clear across the board. I want to do a slight comparison on two companies, just to try and hammer those metrics home. We have Equity Group and KCB Group. At the time I was doing this table, the current prices were 44 for equity and KCB was at 30. And we can come to this column of earnings per share. We see Equity Group had earnings per share of 12.1, KCB Group had earnings per share of 12.14. So we can then divert this and into the price to earnings ratio. So it will just basically be the 44 over 12.1 and the 30 over 12.1. So we see for the price to earnings ratio, Equity Group has a 3.65, while KCB has a 2.5. So on the price to earnings ratio, we remember if it's in a similar industry, as both these are banks, we remember that the lower the price to earnings ratio, the better, the more preferred, because you're paying less price per each unit of earnings. So here KCB Group is better than Equity Group, because KCB, you're paying much less in terms of the price you're paying to the earnings you receive. While in Equity Group, because in KCB you're paying 2.5 price per every unit of earnings. Equity Group, you're paying 3.65 price per every unit of earnings. So here on a relative basis, KCB Group is more attractive. You're paying less for every unit of earnings. And when you then, but when you then look at the dividend yield, KCB Group has a dividend yield of 6.6%, while Equity Group has a dividend yield of almost 9.05. So on the dividend yield, the higher, the better. So Equity Group here has a better dividend yield than KCB Group. So Equity gives back more money to shareholders than KCB Group, because I think the dividends per share here was around 4 shillings and KCB was around 2 shillings per share. So 4 shillings you divide by the price of 44.2, you get 9. 2 shillings you divide by 30.25, you get 6.6%. So that's just how you can do some comparisons. So you can see from price to earnings ratio, KCB Group is a bit more attractive in terms of cost. You're paying less for every unit of earning, but in terms of the dividend yield, Equity Group is paying back more to shareholders than KCB Group. Any question on this? So that's just how you can use ratios to do your analysis of companies that are similar or in similar sectors. It's also good to use companies in similar sectors, because you see, if you come down to this car in general, you have a price to earnings ratio of 16.7. You see, this is way further than these ones for the banking sector, and yet it has a much lower dividend yield at 2.7. So you're paying way more for every unit of earning, and yet you get much less in terms of dividends or in terms of income back to you as a shareholder. All right. If there's no question, I think we can move on. I won't go through this slide. It was just basically to highlight what we had talked about previously on the KCB and the equity group. I want to go through some of the factors that affect the stock market. We talked about the fundamental factors to start with, and these can be economic factors. So GDP growth rate in an economy, how fast the economy is growing, interest rates in an economy also affect the level of the stock market. Usually when everyone is borrowing at an expensive rate, the cost of doing business increases. So the cost of inputs, the cost of increases, and they go, and usually they seep all the way to the final customer. And that is also not that good for the stock market. Inflation is also quite key, as we talked about inflation. One of the things that I also want to mention about inflation is that you need to put your investments in securities or in instruments that earn more than the inflation rate. So that gives you a real rate of return. So your inflation rate, let's say your inflation rate is 7% in the country, then you need to invest in securities or instruments that give you more than 7%. If you invest in something that gives you less than 7%, then your money, then you're worse off after a year or so, because what you could do with your money has decreased by more than what you've earned on it. So let's say your 1,000 shillings, if you just take it literally, your thousand, if you take it literally, if the inflation rate is 7%, more or less, you can buy in 1 year goods worth 930 today. So that's now based on the time value of money. So what you can do with the money, the basket of goods that you can buy has decreased. So unless you get an investment that gives you more than that 7% inflation rate, then you won't be able to buy the same basket of goods at 1,000 than in the future than what you can do now. And finally, for international investors, you also have to look at the exchange rate differences. Like for Kenya, this year, our exchange rate has depreciated significantly against the dollar. So if you are an international investor, you're coming in to invest locally, then the exchange rate will be one of the factors to consider, because you're getting, at the point of exit, you're getting less in terms of your foreign currency than what you did coming in. So that's also a point to consider. The second thing you look at is the industry performance. Industry performance is basically, what industry are you in? Is it growing? Let's say you're in agriculture business, you have agriculture, maybe a coffee company. It's in the agriculture sector, it's in the agriculture industry. So is there growth in that industry, and what are the drivers of that industry? So the industry is growing, is performing well, then that's also good for your company. And finally, we have the individual company performance. So here now you look at the financial results and earnings of the company. So how we've gone down from economic, these are the macro factors, to the industry, to the company, we call this top-down analysis. So you start from the top, being the macros, the country, region, country, factors that affect the market. We narrow it down to the industry, specific industry in the country, and then finally to the company itself. This is called a top-down analysis, and it's also preferred. It's a preferred method of fundamental analysis. Then we also have sentiment. Investors also look at a lot of investor sentiment. I'll highlight some of these factors. Some of the factors is the mood in the market, bullish or bearish mood, the interest rates, the supply and demand, the trading, who is trading, is it retail investors, institutional investors, is there any euphoric behavior, or the opposite of euphoric behavior is fear? Is there a lot of fear in the market? So fear can be things like, let's say there's outbreak of war in the world or in the region. That will be lead to fear in the market. Let's say there's also disputes of an election, for instance, that also leads to a lot of fear in the market, and that will affect the stock market. So these are more of, we call them investor sentiments of the market that also affect the stock market. Yeah. Any question? These are some of the broad factors that affect the market. Yeah. Any question on this? Okay. So from this chart, we can see why this chart embodies why we need to be long-term investors in the equities market. This is a chart of NSE 20 being more or less the 20 top stocks in the NSE. And we see like from 1996 to around 2003, you were on a downtrend. So even if you are holding companies here, most likely you are losing money on capital appreciation. However, if it was a good company, they could still be paying you dividends. So at least you have something in current income. But in terms of share price, this was on a long-term downtrend, and then the market rallied. So then we went onto an uptrend for almost 5 years, where prices were rising and rising, and then there's a sell-off for a couple of years, and now we're just kind of ranging. So that's why it's good to have a long-term investment horizon when you're looking at the equities market, because let's say someone who bought here might still be holding prices less than the prices that they bought at. And that's one of the risks. But at least if you are in a good company, there's a possibility that you're still getting dividends in terms of current income. So it's not the only there's not only doom and gloom. And then also if you have a constant method of buying, let's say you're buying a bit every month, a bit every 3 months, then you get also some prices down here when the prices are cheaper. So that also reduces your average cost, which is good. Okay, so then we can briefly discuss about how to actually go about investing in shares and equities. And here, what we want to highlight mostly is the benefits of buying into an equity fund, for instance, is you do get diversification. For equity funds, especially the ones that are regulated, like let's say there's an equity fund by fund managers in Kenya, there are regulations that the fund has to adhere to. One of them being like you can't have more than 25% in any particular stock or any particular company. So that in itself means that if you're buying into any equity fund, more or less at a minimum, they'll have to buy at least 4 different companies. That gives at least a potential for diversification, whereby let's say one company is not doing so well, maybe another company that the fund purchase is doing well, as opposed to only purchasing one company, so that if it does well or if it does poorly, then you're fully down if it does poorly. But diversification allows for, let's say one part of the market is not doing well, maybe there's a possibility that some other part in the market is doing well, and you can get benefit from that. Again, another benefit of equity fund is, you can delegate the analysis, the following of the metrics to professionals who do this on a day-to-day. So you don't have to be constantly checking up on your company or your stock or what price it came out, what were the results it announced yesterday or the week before. So you don't have to do that analysis by yourself, but you have some professionals doing it for you. And then another advantage is you can develop a strategy that you're adding small amounts on a regular basis to your equity fund, and you'll be able then to enjoy all these benefits of diversification and still having your money being looked after by a professional. But one disadvantage is you will pay for you'll pay them for a fee for managing your funds. So you'll pay them a fee for managing the funds, usually like 1 to 2% of the fee for managing the funds. Now, that is on the surface. However, the fee that you pay at around 2% could be gotten back by the fund manager, because they do have, most of them do have benefits of economies of scale. So the interactions with the broker might be different from a retail investor. And the percentage paid by the fund manager might actually be less than, will most likely be less than what the retail investor will pay because of the benefits of scale. So you might find that if you can just go to the slide on commissions, you can find that for brokerage commissions, they amount to almost 1.76% if you're investing less than 100,000. Yeah. So a minimum of 1.76% for retail traders, and it can actually be more depending on your broker. But then you find for fund managers, they could actually be trading at much less, maybe at even 1.1%. So there's a sort of a savings there, sometimes even a close to 1% savings, because the fund manager has economies of scale when purchasing, as opposed to the retail trader. Again, another benefit might be the retail trader might also not get the best execution. The fund manager might get a better execution, a better price, given again the volumes that they trade. So I think it was good to mention that, so that even if you do have a monthly, even if you do have an upfront management fee, it could be actually pay for itself in some of these other areas, like execution of trades, for instance. And someone who was asking, I think someone was asking about if you pay any transaction fee. There is a monthly transaction fee of 100 shillings, one-off, that is charged by the CDS account. There's some fees that were introduced of late that do feed into your brokerage or your CDS accounts. However, again, if you're using a fund manager, this doesn't normally apply. Any question on the fund managers route? We do have a more we do have a more detailed breakdown here, where we talk about the various funds in the collective investment schemes. So you as an investor, you can come in to a unit trust that's managed by a fund manager. There's also a custodian and a trustee, and these funds are also audited and regulated by the Capital Markets Authority. And there are various funds that the fund manager does allow or does provide. Equity fund may invest primarily in equities and in shares. The fixed income fund invests primarily in treasury bonds, corporate bonds, and some treasury bills. The money market fund is the most liquid and is usually the easiest one to start with, because the initial deposits the initial investment is quite low and is very accessible to most people. We're talking about maybe $10, 1,000 shillings to start with, and this one is much easier to begin with, and it does also provide a lot of the benefits of diversification, access to bank deposits at higher rates, treasury bills. So they do invest in treasury bills. So there's a high likelihood that the money market funds might have a higher rate than if you were to go individually to a bank and get a fixed deposit. And then finally, we have the balance fund that can invest in a mix of equities, fixed income, and money market instruments. Any question on the collective investment scheme, the unit trust? I think a lot of people have heard about unit trusts how to get started in unit trusts, which unit trust to 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 choose. And also there was that, as we said, there was that tool that we can utilize that does have a number of intricate questions that you can ask your fund manager, of any fees, any hidden charges that they might have, and that can be a good way to go about investing or figuring out how to pick a fund manager. Also, we've gone digitally. A lot of fund managers also allow you to invest digitally, to open an account digitally, send money via, either electronic means or even through money services like M-Pesa or the like. And you quickly set up and they start investing for your money for you, maybe even the following day. So I think unit trusts have really helped in the investing culture, and I will advise it as a good option for saving and also for investment. So I think we covered this. So this is just basically the structure. As we said, you as an investor, you come into the unit trust that's offered by the fund manager. The fund manager manages the unit trust. The custodian holds the assets of the unit trust. So custodian is usually a bank or financial institution. They're usually banks that hold the securities. So all the securities might be held at, let's say, KCB custody services. So as a fund manager, you have a custodial account with KCB custodial services. So all the assets are held at that custodian level. So the fund manager doesn't actually hold the securities on their books. So it clearly demarcates the assets of the fund manager vis-a-vis the assets of the unit trust. And then finally, you have the trustees that more or less are they safeguard the assets. You have to report to the fund managers have to report to the trustees on a regular basis, maybe quarterly, on where the assets have been invested. And this is just a flowchart for the money market fund. As we said, you invest in the money market fund, you get units in the money market fund. The money market fund then invests in all these commercial cash and cash equivalents and cash securities, treasury bills, commercial paper, treasury bonds, and other short-term securities. They give a return, and the money market fund distributes this return to you as an investor. So you can even come today, invest 1,000 shillings, maybe in 2 weeks of time or so, it has grown by some interest, and you can withdraw that you can withdraw that increment or that interest increment, as they do pay distribution. Most of the time, they even pay distribution daily. So that's why the money market fund is quite popular and quite adept for savings, because the access is there, and it does also provide you with a better form of current income and current returns as compared to maybe if you went directly to invest in bank deposit, for instance. So for the key characteristic of money market fund: capital preservation. So they preserve your capital, and it also gives you income, while at the same time giving you capital growth. So money market fund is a diversified fund, low risk fund that invests in a variety of near-term cash securities. So it is very, very highly recommended for savings and maybe to start your investment journey, because even the barriers to entry, as we said, are quite low. And unless there are any other questions, I would like to I'd like to close the training there and invite any questions. Any question? Any burning question from participants? Allow me to share my email. Should you wish to discuss further on anything that we've covered, you can email me and I'll get back to you. So the floor is open for any questions at this juncture. It doesn't have to be, it can be from any part of the training that we went through. All right, any question? I think if I'm not closing anyone out, I think I can hand it over back to you, Kathleen, to end for us the session. Over to you. Kathleen?
Yes, I'm here.
All right. I'm saying, I'm saying, barring any last minute question or any burning question by any of the participants, I think we can close it.
Okay. All right. I see you have sent your email. Let me just put it in the chat box so everyone can see.
Okay.
In case they have any questions. I'm trying to see if we have anyone from the wellness team before we close this. So unfortunately not. Allow me to just ask you to just take a minute to fill out the feedback form. The link is in the chat box. Please just let me know how the training was. What would you like to be discussed further in the training, especially pertaining to savings and investment? And what are your thoughts generally? It will only take you a minute. Other than that, allow me to wish you all the best, even as you proceed with your personal financial management journey. It has been a pleasure to have all of you right from module 1 all the way to module 4. Tomorrow we'll have another session on savings and investment for group 3, but you're more than welcome to come and join in case you'd like to revisit the conversation. We will share with you the recording of this session or a session of module 4 in case you also want to revisit the conversation during the implementation process. Please feel free to contact Caleb. He has left his email address. In case you have any questions, in case you have any concerns, even as you implement the insights that we have learned here. Other than that, allow me to wish you all the best and have a great rest of the day. Thank you so much for being here with us from the start to the end. I really appreciate. Caleb, thank you so much for your availability and just delivering the insights and the knowledge, which is very purposeful and will help us to implement some of the goals and ambitions that we have when it comes to personal financial management. Thank you so much. That being said, allow me to wish you a great rest of the day. You're more than welcome to join tomorrow's session. Should you have the time, a recording of this will be shared. All right. Thank you so much. Good day.
Thank you. Goodbye.
Bye-bye.
Thank you. Bye-bye.
Thank you. Thanks a lot.